Afternoon, boys and girls. It's a weekly wrap up for January 14th, 2022. I'm Raymond Dahlman, your humble host here at DSA Financial Group. Hope everyone's having a fantastic week. It's a little snowy outside. We're expecting somewhere between 4 to 8 inches today. So in my future, I am imagining a snowblower and a shovel. I think I'm going to be right. So, like I said, hope everybody had a great week. Kind of a boring week as far as the markets. There's been a lot of talk about inflation. Obviously, there's been some, what's the word I want to use here? Turmoil about the COVID mandates that went up to the Supreme Court. I talked about yesterday the two rulings that came out. One that the employers of 100 or more do not have to abide by that executive order. Although if you work for a company that does or a medical facility that receives federal benefits, you're going to have to wind up probably getting your shot. So I feel bad for those people. My body, my choice. I hear that a lot out of people on the left. I'm not sure why everyone needs to get a vaccine for a cold, especially if you're under 60. I'm not going to go into the stats today on it, but anyways. All right, well, let's take a peek at the indexes and see how they did today. The Dow Jones was down 0.56, closed at 35,911. The S&P 500 was up 0.08, closed at 4662. NASDAQ was up 0.59, closed at 14,893. Small caps were slightly up at 0.09. The VIX receded today, down 5.51% to close at 19.19. So even though, the Dow Jones was down 0.5% today, NASDAQ was back up 0.5%. It is good to see that the VIX has receded a bit back below 20. Let's take a peek and see how Europe was mostly red. Looks like the best performing was the FTSE 100, and the worst performing in Europe was the Eurostoxx 50. All right, and down across Asia last night, lots of red. New Zealand was down 1.08, or I'm sorry, Australia 1.08, New Zealand down 1.24. The Shanghai was down 0.96. The SZSE component was up 0.09. China A50 down 1.23 or 1.23. The DJ Shanghai down 0.9. And that Hang Seng was down 0.19. So a lot of red across things except for the S&P 500, NASDAQ. So, not the greatest week when it's all said and done, but certainly not the worst. All right, let's take a look and see how the indexes did this week. All right. Dow Jones looks like it was down about 0.78 for the week. S&P 500 slightly up about 0.14. NASDAQ for the week looks flat, up 0.15. Dow Transports were down about a little over 2%. And the Dow Utilities were down about 1.48. So across the board, the market was down for the week, but not tremendously. I mean, we are there is a lot of worry about rising interest rates, paying out or unwinding the balance sheet. So a lot of this probably has to do with that. All right, well, let's take a look and see how the economic numbers came in this week. U.S. jobless claims came in at 230,000. The forecast was 200,000. But again, looking back at the historical numbers, we've gotten back down to around that 200,000 level, which, if anyone who watches me on a regular basis knows that, 175 to 200,000 a week is pretty common. It's not outside the norm. So that looks really good. U.S. jobless claims came in at 1.559 million. The forecast was 1.733 million. So beat the forecast by almost 200,000. So that does look excellent. Let's hope next week's trend continues. But we've been under 2 million continuing jobless claims since the November 24th report. So, that's, going on 2 months now that, or just about almost 2 months that we've been below that 2 million number, which again, really good. I know I always talk about the negative things going on. So I like to point out some positive bright spots. The U.S. Consumer Price Index, this came in at 7%. The forecast was 7%. So right on what they forecasted. I don't know if that's really ideal. As you can see over the last year, inflation has crept up. This is the highest recorded number. It looks like, let's see if we go back out. Definitely since the 90s. The highest before that was in, looks like April of 80. It was 14.8%. And then before that, 12.3% in January of 75. So we're not quite to the double-digit numbers of where we were in 75 and 80, but, it is certainly the highest it's been. Let's see, this was, looks like the highest number was 5.4%, and that was in September of 2008. We all remember what was happening going into the fall of 2008. The market was getting ready to melt down, and or we were already in meltdown mode, and it was just getting worse as we went into the first quarter of 2009. But, hopefully, we see some regression in that number over the next couple of months. I'd hate to see it continue to climb, but, we'll see what the Fed does. All right. The core consumer price index, core takes out several things that are in the main CPI number. I don't have it right here. Oh, it excludes food and energy. That's the, two things we never use, food or energy. All right. The core was up 5.5%. The forecast was 5.4. Again, right, fairly close. But again, this has been trending up the last few months. I would really like to see that start to head back down before I start to feel better about prices. All right. The producer price index year over year came in at 9.7%. Forecast was 9.8. Last month's number was a 9.8 also. So, that is pretty high. This is the, cost of goods sold by manufacturers. So year over year, they're selling for almost 10% higher than they were a year ago. Not good, especially when the consumer price index is up 7. This is up almost 10. It's, it's not something not to worry about. All right. Retail sales year over year up 16.95%. The previous month was 18.24. So that looks pretty strong. I mean, especially considering the negative months we had last year, almost 2 years ago. But that does look pretty good. And the industrial production number came in at 3.67%. Last month's was 4.98. So, production has been slowing down. However, we did have a lot of negative months, leading into this year. So, it'll take probably a year or so to see what where things really shake out long term. The U.S. Consumer Sentiment Survey came in at 68.8%. Forecast was 70. Essentially, this is, if it's higher than expected, it's bullish. If it's lower than expected, it's considered a bearish sign. So, we've had since, right before all this began, at the beginning of 2020, the consumer sentiment was up near 100, and today we're under 70. So, not the greatest situation to be in. I think if, the jobs numbers continue to improve and, we start to see a reduction in inflation, hopefully we would see these numbers start to creep back up to a positive trend. And then lastly, the oil rig count from Baker Hughes this week came in at 492. Last week's was 481. So you can see, there was a bit of a stall at the end of the year, probably just due to the holidays. But we're up 11 more rigs since last week. So, hey, that's good. That should help with some of the strain that is on the energy sector. All right. Well, I have a couple articles I want to breeze through. This one comes from NerdWallet. It's the 2021 American Household Credit Card Debt Study. They were evidently yapping about it on Fox Business this morning, so I figured I'd go and pull the article since they're talking about it. And some interesting little tidbits in here. Let's go ahead and read through this. The pandemic continues, as does the financial strain it has placed on many Americans. Total debt has increased over the past 12 months, although revolving credit card debt is down and the cost of living is growing faster than household incomes. NerdWallet's annual look at credit card and other forms of household debt finds that credit card balances carried from month to month are down significantly, almost 14% from a year earlier, falling to $357 billion as of September of 2021. But other types of debts, other types of debt types tracked by the study, including mortgage, auto, and student loan debt, increased over the past 12 months, as did overall debt. And overall credit card debt, meaning all balances, not just those carried over from month to month to the next month, is steadily increasing again. Here's a breakdown of what U.S. households owed, both in total and the average amount per household in each kind of debt. All right, total debt on average was $155,622. Total in the U.S. went 15.24 trillion, and that's a increase of 6.2% from the year before. Credit card debt was the average credit card debt was $6,006. The total was $357 billion. It was down 13.85%. Mortgage balances averaged $207,861 for a total of $10.67 trillion. That was up 8.22%. Auto loans, the average auto loan is $28,882 for a total of $1.44 trillion, up 6.10%. And student loans, the average student loan balance is $59,042, and for a total of $1.58 trillion, and that climbed 2.46%. So, I mean, just looking at these numbers, I am actually pleased. Being a former debt and recovery collector, makes me happy to see credit cards going down because they're not tied to an asset as opposed to your mortgage or your autos or any other. If you own a business, like machinery and things like that, they're all worth something. So even if your business or your household goes tits up, the value of the items that you have loans against, you should be able to at least break even long term. So, and also what I see, I mean, there's been a lot of people out there buying houses, buying new cars. I mean, it's just been, with interest rates as low as they are, it's not surprising to see that the mortgage or total mortgages has gone up this year or the last 12 months. And same thing with auto loans. A lot of people have been, trading in their used vehicles because they're worth so much. I mean, just in my case, I just out of curiosity last year looked to see what my 2016 F-350 would be worth, and it was damn near worth what I paid for it going on 6 years ago. So there are a lot of people doing that. They're trading in old to get new. I don't know if that's necessarily the best idea. If something's already working and it's not giving you any problems, might as well hold on to it. But that's just kind of the way things are. All right. So our annual study analyzes government data, including statistics from the U.S. Census Bureau and the Federal Reserve Bank of New York, to track the changes in household debt over the past year. For further insight on how the pandemic continues to affect finances of Americans, NerdWallet commissioned an online survey of more than 2,000 U.S. adults conducted by the Harris Poll. The survey found that Americans who received pandemic relief since March of 2020, 22% used at least some of it to pay off or down credit card debt, which could partially explain the drop in revolving credit card debt over the past year. Key findings: the cost of living has been rising faster than income in recent years. Median household income has fallen 3% over the past 3 years, while overall costs of living is up 7%. This is a sharp reversal of a decade-long trend in which income growth has exceeded inflation, although incomes are still ahead of the cost of living if you look at the 10 years starting at 2011. Americans have been financially struggling over the past year to a point. The past year point to both lower income and higher expenses. More than a third of Americans, 35%, say their household finances financial situation has gotten worse over the past 12 months, according to the survey. Of that group, 38% say that's because their household income decreased overall, and 36% say it's because their household expenses have increased overall. More than 1 in 5 of those whose finances have worsened say it's because they've lost their job. Top use of pandemic relief includes paying for necessities and savings. Survey showed that more than 3/4 of Americans, 78%, have received some form of pandemic relief since March of 2020. The top uses they say found for this money were paying for necessities, 43%, and adding it to their savings, another 43%. Because lower revolving balances, average credit card interest is down. In the U.S., the average U.S. households that carry credit card debt will pay interest charges of $1,029 on average this year. Credit cards helped some Americans through the pandemic. The study found that 1 in 5 Americans, 18%, relied on credit cards to pay for necessities during the pandemic, and 17% relied on them for emergencies during this time. While carrying debt on a credit card is usually an expensive proposition due to interest, credit cards can be a lifeline in a challenging situation like a pandemic. So definitely some interesting little facts there. If you want to read through the rest of the article, I have it linked here in the show notes. All right, next one. The misery index is rising. What that says about rates. All right, now in the winter of our discontent, it should not be surprising that the misery index has made a comeback. Those of a certain age will recall it was a measure conceived in the 1960s by economist Arthur Okun, then an advisor to President Lyndon Johnson. It added unemployment to inflation. Some would describe the economic woes faced by most of us whose concerns might be more banal than the difficulty of finding a slip big enough for a new mega yacht. Except for the 0.1% having a job and being able to pay the bills ranks higher on the worry list. During the post-World War II era, the misery index ranged from just a low under 3 in July of 1953 when inflation was negligible and the U.S. was fully employed to about 22 in June of 1980 at the height of stagflation under President Jimmy Peanuts. The misery index was in a steady ascent last year, pushing into double digits in April and standing at 10.93 in December. Not surprisingly, as misery increased, the University of Michigan's Consumer Sentiment Index started to roll over. The last time the misery index got into the double digits was May of 2012, when it was 10.4%, with unemployment at 8.1% during the slow recovery from the recession that followed the financial crisis. But inflation was subdued then at 2.3%, as it had been for most of the past quarter century. That is until last year. The misery index and consumer sentiment fell despite a steady decline in the jobless rate to 3.9% in December. Inflation has proved more intransigent than transitory, the term the Federal Reserve officials optimistically used, and that has spelled misery for those having to pay higher prices. And so inflation moved to the evening news and front pages of newspapers this past week, with the consumer price index rising 7% in December from a year earlier, the biggest year-over-year increase in 4 decades. The blame gets pinned on the much publicized kinks in the supply chain as the COVID-19 pandemic persisted. I don't think that the supply chain problems necessarily are the reason for the high inflation. I think it more has to do with the Fed's actions of creating 25% of the money supply within the last 2 years. That's a bigger reason. But Joseph Carson, former chief economist of AllianceBernstein, who has consistently sounded the klaxon about inflation, finds that easy money boosted reported inflation as much as supply chain shortages and bottlenecks. I just said that. He assumed supply constraints accounted for all of the jumps in prices of new and used vehicles, rental cars, household furnishings and appliances, apparel, sporting goods, and the food consumed away from home. All told, he figures those items accounted for about 3.5 percentage points of the 7% rise in CPI. While news stories trumpeted that this was biggest yearly rise in CPI in almost 4 decades, Carson points out that the jump would have been much larger if the index was calculated using the formula used before 1982, which counted house prices to estimate homeowners' housing costs. Housing prices were up 19% from a year earlier, according to the most recent S&P CoreLogic Case-Shiller Composite Index. Imputed rent, a measure of CPI that estimates what homeowners would be willing to pay to rent their homes, was only up 3.8%. Adjusting the homeowners' costs for actual prices would have added an additional 3.5% points to the reported 7% rise of the CPI. Easy money contributed to this actual surge in inflation, while the pandemic pumped up prices, Carson contends. Somehow we doubted that there are houses or condos on container ships anchored off the West Coast that would easily ease a tight housing market. What's also different from the last time inflation ran this hot was the federal funds rate, which Jim Reed, head of thematic research at Deutsche Bank, observed was at 13% in 1982, with the Fed now continuing to peg its key policy rate at 0 to 0.25%. The real rate, after adjusting for inflation, is below anything we've seen during the Great Inflation of the 1970s, and only comparable to the World War II era, he wrote in a client note. Deeply negative real rates equate to super easy money. At his confirmation hearing before the Senate Banking Committee this week, Federal Reserve Chairman Jerome Powell reiterated the central bank's intention to keep the current inflation from getting embedded in the economy. But when asked by Senator Pat Toomey how realistic it was to bring back inflation to the Fed's targets while maintaining negative real interest rates, Powell's initial response was to blame disruptions causing supply to trail demand. He added, if the Fed sees inflation persist, it will use its tools and raise rates. Meanwhile, the Fed's policy remains very expansionary in the face of the inflation that's making us miserable. While most of that has been in soaring prices of goods, higher service costs may become the greater problem, especially as lagging rents start to feed into the CPI. So, all right, that's most of that. So, I mean, it is interesting to follow this number and see how high it goes. It's also, I talked about in recent podcasts where CPI isn't exactly an apples to apples comparison to the 70s to now, simply because of all the changes to the calculation over the last few decades. All right, and last one is the money supply grew in November, but the bigger trend is way down. This was written by Ryan McMacken, and this was from Mises Wire. All right, let me please increase that. All right. Money supply growth rose slightly in November, rising above October's 21-month low. Even with November's rise, though, money supply growth remains far below the unprecedented highs experienced during much of the past 2 years. During the 13 months between April 2020 to April 2021, money supply growth in the United States often climbed above 35%, well above the high levels experienced from 2009 to 2013, as money supply growth returns to normal, quote unquote. However, this may point to recessionary pressures in the near future. During the November 2021, year-over-year growth of the money supply was at 7.0%. That's up from October's rate of 6.2%, down from November's 2020 rate of 36.8%. Growth peaked in February of 2021 at 39.1%. Historically, the growth rates during most of 2020 and through April of 2021 were much higher than anything we'd seen during previous cycles, with the 1970s being the only period that comes close. The money supply metric used here, the True or Rothbard-Salerno money supply measure, TMS, is the metric developed by Murray Rothbard and Joseph Salerno, and is designed to provide a much better measure of the money supply fluctuations than M2. The Mises Institute now offers regular updates on this metric and its growth. The measure of the money supply differs from M2 in that it includes treasury deposits at the Fed and excludes short-time deposits and retail money funds. M2 growth rates have been largely stable for the past 6 months, with the growth rate in November falling slightly to 12.7%. That's down slightly from October's growth rate of 12.5%. November's rate was well down from November 22's rate of 24.4%. M2 growth peaked at an all new high of 27% in February of 2021. Money supply growth can often be a helpful measure of economic activity and an indicator of coming recessions. During periods of economic boom, money supply tends to grow quickly as commercial banks make more loans. Recessions, on the other hand, tend to be preceded by periods of slow rates of money growth. However, money supply growth trends to begin growing again before the onset of a recession. As a recession nears, the TMS growth rate typically climbs and becomes a larger Then the M2 growth rate, this occurred in the early months of 2002 and 2009 crises. A similar pattern appeared before the 2020 recession. Money supply growth fell throughout much of 2019, and the economy appeared headed towards recession. However, the lockdowns and the stay-at-home orders of the COVID panic accelerated the process and ensured a sizable drop in economic activity. Massive stimulus then pushed money supply growth up to record levels. All right. So that's, again, I'm going to go ahead and stop that there. As we've talked about quite a bit, the money supply is primarily the main trigger for inflation. And, the excess amount of dollars that have been pushed into the system over the last 2 years have really hit us in the wallets. Although, based upon this article, it looks like things have stabilized a lot over the last 6 months. So that, hopefully that's, a good trend to look at. And, we'll see where things go from there. So, all righty. Last thing I had is, we lost Mr. Bob Saget this week, and made me think about where, the first time I saw him, it was actually on the Rodney Dangerfield's 9th Young Comedian special back in 1985. And I know me and my brother and my friends, we watched this a lot growing up. So I'm gonna go ahead and share Bob's little segment here with us, and go ahead and this will take us out for the week. Go ahead and turn this on.
But he's lonely. He needs acceptance. Make him happy, won't you? Bob Saget, how about it? All right, Bobby, here we are now.
Thank you. Guys, you're a wonderful audience. You really are. I'm not just kissing up. I'm really not. I swear. I'm slobbering all over you is what I'm doing, because I need you to like me real bad, because I have no act, and I have no life, and I have no future. I'm serious. My mom is Gumby, my dad is Pokey, and I'm Mr. Potato Head. So I talk real fast. If you have any drugs, take them now. I'm serious. I'm not funny, but I am quick. That's the problem I have with women, too. But it's good to be here. It really is. And you're a great crowd. I'm not just kissing up again. It's the second time I've done that. I just want to take a jacuzzi with you and throw in a toaster. I'm not kidding. I've never been this happy. But you're a great crowd, and I care about all you individually. I just want to have sex with you right now. I'm serious. But I can. I'm working right now. But I'm a happy guy, because I got married. Married my girlfriend of 7 years. At her age, I'm going to jail. Well, I did. I really am in love. I told her tonight, I said, when I come home, I want to make love to you badly. And she said, at least you don't overestimate yourself. But I'm nuts over her. She's this tall. It's my dad's joke. I'm sorry you laughed at that. I've lost respect for you. I really have. Everybody needs friends, I had it rough when I was a kid. Never got to go to camp. My mom thought I get embarrassed undressing in front of little boys, but I've changed because I kind of like it now. That's not true. I'm no senator. But thank you very much. I never got to sleep over my friends' houses. Anybody get to do that? You slept over my friends' houses? I never got to. I said, Mom, why not? She said, Bob, you have no friends and you have no life, and I'm not your mother, okay? But I love my mom, and you can too for just $12.
I love that.
That was easy. Let that go. I'm sorry. Don't applaud that. You're scum, buddy. You really are. I live in California now, which is nice, but I'm actually frightened to death of an earthquake. I'm really scared of it. Californians don't care. It's like, oh, look, the ground's opening up. There goes my house. There go my wife and kids. It's Miller time. I'm scared there's going to be like a major quake and I'll be getting a vasectomy at the time. That's what I'm scared of. It was a 7.3, but now it's a 4.1. But I won't do that, damn it, because I want to have a kid. I really do. Right now I'm in no position to have a kid because I'm standing up and I'm alone. But I want to have a kid, but we've been trying to have a kid. Well, my wife's trying. I just lay there. But I won't breastfeed. Damn it, I won't do it. Men can breastfeed. Did you know that? I read that. Okay, I made it up. No, I read it. I wrote it down and then I read it. I believe everything I read. Men can breastfeed, but you have to actually take cans of evaporated milk to your chest. Give the baby an opener, I remember when I was just a little baby, my mother was looking down and she said, Bob, you've had enough. And I said, don't act like you don't like it. I was young, but I was a smart kid. But there's so much bad stimulus out there for kids. I was in a toy store recently. There's this new doll out. It's half man, half woman. It's called Gee, I Don't Know.
Ooh, that wouldn't go over well today.
Real nice. I had a good time. Thank you very much.
Thank you, Bob. We're going to miss you. So, yeah, I was 11 years old. Wow. Now I'm going on 48. So it's sad. There were a lot of great comedians on that special. Let's see. There were let's see who they were. It was Maurice LaMarche, Richie Gold, Bob Nelson, Rita Rudner, Harry Basil, Sam Kinison, Bob Saget, and Louis Anderson. And of course, Rodney Dangerfield hosted it. So sad. Most of those, or a lot of those people are gone now. So, all right. Well, that's everything I had for today. I hope everyone enjoyed this. Be sure to like, subscribe, and share. If there's anything that you need from me, don't hesitate to reach out. If you're not a client, feel free to go to the website, dsafinancialgroup.com, to book an appointment or to give me a call or shoot me an email with a question. But hope everyone has a fantastic weekend. If you're anywhere where it snows, try to stay warm and dry. If you're part of my friends and family down in Texas, try to stay cool because it's usually hot down there. So, all right. Well, everyone have a good one, and I'll be back on Monday with the weekly economic update. Bye-bye.